Welcome to the Real Estate Wealth Podcast, where we explore real estate as the most proven way to financial freedom. Join us for insights with leading experts and discover how vibrant health and an abundance mindset are the keys to true wealth. Welcome to another exciting episode of the Real Estate Wealth Podcast. Today, we welcome Chris Lee. Chris is the CEO and founder of CEL & Associates, a leading real estate consulting firm based here in Los Angeles. Chris has been at the forefront of real estate strategy and analysis for more than 30 years. His firm works with a range of clients from institutional investors to smaller investors to developers, helping them craft long-term strategies for success in an ever-changing market. And full disclosure, CalCap is currently one of those clients, as Chris is helping us with some long-term strategic planning. Chris, thank you for joining us today and welcome to the Real Estate Wealth Podcast.
Thank you very much for inviting me. I'm looking forward to it.
Great. Is there anything you want to add to my little intro about CEL or yourself?
No, you've been very kind. I just have to live up to your expectations.
Oh, you will. You are a wealth of knowledge. So I appreciate you coming on the show. So Chris, you wrote a white paper, I think 2 years ago, entitled, "When Will the Good Old Days Return? Never," which I love that title because it kind of reminds me of, I think, you're alluding to like what Mark Twain once said, which is history never repeats itself, but it often rhymes, right? And I think, that can be held true in the real estate industry, really as well as anything. I think you and I spoke about when I first met you, a book called The Fourth Turning, which kind of goes through that, right? It goes through demographics and how, over centuries, thousands of years, basically demographics really shape kind of human behavior and, political environments, financial markets, everything. And we're sort of seeing that right now, right, as we're living through a fourth turning, if you believe the book, which it seems like we are. So, but getting back to real estate, where do you kind of see the real estate market today? I mean, there's been a lot of changes, even since you wrote the white paper in 2022, right, with the massive increase in interest rates. How do you kind of view the market today? And where do you think things in the short term, where do you see things going in commercial real estate and specifically, since we're multifamily investors in the multifamily market?
Sure. And I do recommend to all your listeners, all the books by Strauss and Howe. The Fourth Turning is a great one. All of them about generations are great ones.
I haven't read the others, but Fourth Turning is tremendous.
Yeah, they're great books. Look at it. The real estate's a marathon, not a sprint. And there's going to be times of challenge. There's also going to be times of opportunity. And if you step back just a little bit, we've had multiple interest rate spikes since 1981. We've had 11 recessions, since 1950. Each of those times, multifamily came out, flourished, it did very well. We've had high inflation and we've had low inflation since 1950s, but multifamily still grew. And so, but the difficulty is today, right now, about 44% or so of U.S. adults have only 3 months of savings and about 27% have no savings at all. And so renting is becoming the only option for millions and millions of people because of the current challenges economically, financially, and market-wise in the country. Our national affordability index is like 93. I think the high back in 2020 was over 109, almost 110. So affordability has become a very large factor in going on here. Also, 56% of U.S. households receive some form of government benefit or some form of government assistance. 56%, which shows you that the economic structure is much more geared to a for-rent market than it's going to be for a for-sale market going forward. I mean, it's very, very clear. But when you take a look at all those factors here, it's important to remember that we have to be very cautious because in times like this, caution is absolutely the cornerstone of all of that. But I said in my paper, we're moving to a renter-based society, absolutely moving to a renter-based society. But this year, in 24, we're going to have about 500,000 completions, which is going to put a lot of strain. That's up, 9% from 23 and about 20 or 30% probably since 22. And that's going to put some strain on some of the oversupplied markets today. But again, real estate has always been one of those ups and downs kind of places where oversupplies, undersupplies. But we don't forget that in Europe, home ownership is in the 40s and the 50s. And I do believe, as I wrote in my paper, I believe we're headed for a home ownership rate probably in the low 60s, high 50s by 2030. So it's going to be a choppy 20, 24, and 25 as the interest rates, election year, all those things come forward. But all of the metrics along the way point for a very, very robust multifamily outlook. And let me just say one more thing, Ed. One of the things I've shared with you is that when you look at the basic essential elements of life, you come down to three things: food, shelter, and wellness. People have to eat. People, if they break a leg, need to get fixed, and they need a roof over their head. And what is the best, lowest common denominator of all that? Rental housing. So I really believe that economically, financially, demographically, we're in a very big shift where we're going to see a lot more renters than fewer renters going forward. We just have to muddle through this 24 and early 25 period.
Yeah, it's interesting you mentioned Europe, because I was thinking, and I've recently read sort of the same things, right? In the U.S., I don't want to say we've taken housing for granted, because we haven't, but, the American dream, and I think in 2007, it peaked at 68% homeownership or something closer to 70%. But you're right, the rest of the world is nowhere near those numbers, right? And I think one of the lessons coming out of the Great Recession was, well, maybe homeownership isn't for everyone, because of the mortgage bust, of course, back then, right? And giving 80-20 loans, nothing down loans to people that weren't financially, capable of handling it. So you see us moving more towards a renter nation. I agree with you. It seems like, housing, for better or for worse, may become almost more of a luxury item, right? And I don't know if that's necessarily good from a societal standpoint, right? Because we're seeing already the rich get richer and the poor get poorer, what we've seen at least over the last, decade. And so, that concerns me somewhat from just a societal stability standpoint. But affordability, obviously, it's a huge topic. It's one of the hottest topics in Washington today, which is why we're seeing President Biden calling for things like national rent control, rent caps, that sort of stuff, which I think is the natural outflow of, people having problems affording to buy a house and being forced to rent. And then rents, because of the demand, landlords have been able to increase rents substantially.
Well, and if you really look at the statistics, we've built a plethora of 1 and 2 bedroom studio, 1 and 2 bedroom apartments. We have very, very few, probably 10, 12% of our stock is 3 and 4 bedroom. But when you start moving to work from home, you work with a couple that's having one child, you cannot get by in a studio 1 bedroom. It just doesn't work. So I think we're going to see a lot more changes in that way, where we're going to see some more 3 bedroom and 4 bedroom. I think you'll see the properties themselves change a lot. We'll have much more common space that people can utilize for meetings, for Zoom calls, that kind of stuff. So I just think it is changing. And I also think demographically, the younger people are also looking at other places to place their money, whether that's in the stock market or the bond market or other places. So real estate has been that. And the last thing I would say, though, is economically, we have thrived on a home building, home society marketplace, because you have to buy a refrigerator, you have to buy a vacuum cleaner, you got to buy all this stuff. But when you move into an apartment, it's much smaller, so you don't have as many couches, many beds, as many whatever. And so that's going to have a huge impact economically as we pivot a little bit about what kind of a economic structure we're going to have going longer term. But yes, there are huge implications. But I think we're moving to a renter-based society, a lot more flexibility. The work from home has really changed all that. COVID changed that as well. And so I think it just means, though, that multifamily and for rent continues to be a real, shining star as we go forward.
Right. And like you alluded to, we did see it, interestingly enough, during COVID, when work from home kind of became in vogue. And I think some type of work from home is here to stay, in my opinion. Right. I don't see the office environment going back to sort of, 2019 ever, really, because I think employers have learned to appreciate they can cut their office footprint and their expense. And many employees, have cut their commutes substantially, and it's worked for the most part. It seems to have worked for most companies.
And take a look at us. We're having this thing virtually. Normally, 10 years ago, we would have had to be in the same room together.
Right.
And so this
Right.
just shows you how things do change dynamically. And that's all exciting. We've changed as a society. And I think, again, the outlook is bright, but we're going to have to muddle through the rest of 24 and into the first part of 25.
And it's funny because the whole work from home actually increased the need, in terms of rental housing. You're talking about studios and one bedrooms. Now, say you have roommates that were sharing, an apartment, and all of a sudden one of them is like, well, my boss is going to let me work from home now. We need a third bedroom, right? Or what have you. So we've seen that increase as well, which has been interesting from just an increasing demand, not only from, the affordability renter sort of nation that we're seeing, but now jobs being forced into the home has, required additional space.
And that brings up a whole nother point because I looked at a number of statistics about things that what happens in a home. 70% of decisions you make in life occur in a home. Whether buy a car, get married, have a child, get a divorce, whatever transfer, those all happen. Typically, 70% of those happen in a home. But in a renter-based society, that means that the unit is no longer a unit; it's a home. It means that people are going to want to expect more home-like amenities, home-like features, things of that nature. And I think that's going to really alter both the design and the amenities and the features and the services that products will have in multifamily over the next several years.
Yeah, and I want to get into that a little more down the road. But let's take a step back and kind of back to your white paper and looking at the history of commercial real estate and the evolution of things. One thing you mentioned was, back in the 1950s, 60s, it was more of a localized regional business, right? And then through those decades, the model sort of transformed into more institutionalized, which we see today, and what you say a capital-driven model. Would you mind kind of expounding on how that evolved and what you mean by that?
Sure. I mean, in the past, we always had the local regional developer who knew everybody, knew the school board. Their kids went to school there. They were building great communities. It was a sense of a community contribution. But now the way the capital markets have changed so dramatically is that the capital might be in Korea or in Germany or in New York City, and they're building an apartment in Los Angeles or in Dallas, and they don't have the same connectivity to it. So what ends up happening is that the apartment community becomes less of that home and much more about yield, return. How much am I getting? What's my money earning today? And that's going to have a very, very big impact, on the way we look at things. So that is a concern that I have here. But when you look at just generally, I mean, transactional volumes are off 50, 60%, 70% in some markets,
Yes.
this year. The credit markets have tightened up. Light tech has taken a much more higher profile in terms of the affordable products that are out there today. But multifamily still has Freddie, Fannie, and HUD financing. But as you go forward here, the capital markets have become more of a determiner of outcomes, and I don't think that's really as healthy. One bit of information as an example, in Los Angeles, 70% of the buildings in downtown Los Angeles are owned by people who don't even live in Los Angeles. Pension funds, insurance companies, investors from, Abu Dhabi or whatever. They have no idea what's going on, how many homeless, what's the education, how the schools are performing. They don't care. It's much more what is my return, yield, occupancy. And I think that's what's missing. And I think also that creates an opportunity for real estate to not forget its roots, making a difference in the communities in which they flourish, creating products that people want to be in, whether that's an apartment building or an office building or a shopping center, is creating places that add to the value of the community. I think that makes our communities healthier, and I think that's the best outcome. But right now we're moving much more capital centric. And I think that's going to be debate really over the next several years, because as you said earlier in your comments, if capital becomes that kind of concern, then what ends up happening, it becomes a control factor. So if you want capital, maybe you're going to have to do, rent control. If you want capital, you have no evictions. If you want capital, you have to do this. You have to have 20% inclusionary zoning. If you want capital. So suddenly capital becomes the outcome of a product rather than necessarily the outcome being what's best for the community in creating those homes and environments that people want to be in.
Yeah, no, that's exactly right. And, we're starting to see that already, right? With Fannie and Freddie, during COVID, they were starting to impose some additional regulations that other forms of capital, if you had a bank loan, you didn't have to do, like adding an additional 30 days to the eviction process
Right.
during COVID, which lo and behold, we're way past that. And guess what? It never went away, right? So as typical of government regulations, once they get their teeth in, they usually stay. And that concerns me too, right? Because we're users of government debt, vis-a-vis the agencies. And you're right. I mean, we're seeing now with, talk of rent control, rent caps, the way for the government to sort of implement that stuff, the easiest way for them to do it is
Well, and
through
also
the capital.
you also have to add in ESG to that as well.
Mm-hmm.
So all of the environmental issues that you have to have in your buildings now, all those different things become apparent. But there's also sort of like a little bit of a shining light. I think all of this hubris over AI, as an example, I think that AI is not, there's a lot of money out there chasing AI that's not getting a good return. I think that's going to come back into real estate. I would really watch for a real influx of private equity over the next 3 or 4 or 5 years as people get over the exuberance of an AI platform and get back into core assets, that I think are going to make a lot of money. So I do think we're going to be the beneficiary, but it's going to be with some degree of controls, and we just have to be very careful. So that, when I wrote about that several years ago, I was concerned about that going forward. And unfortunately, capital has taken hold. As well as I, every time you go to a meeting, okay, so how is that asset performing? What's the rent? What's the occupancy? Are we driving rents? How are we driving this? And which is great from an investor perspective, but I don't want us to lose sight that, a residence is a home, a unit is a home, it's a place, and an apartment community is a community. It's not just a series of detached people living in detached units with the detached connectivity to society. It's just not the way.
It's part of a neighborhood with its own
Correct.
cultures and customs, and it's very different. And I know you preach, and we do too, that real estate is a localized phenomena. I mean, you need boots on the ground, even though you can do it nationally or internationally. It's so important to have boots on the ground for those reasons in specific markets, because it's in order to really understand. I mean, you go to places in Texas like at Houston or even Dallas. I mean, neighborhood to neighborhood, even sometimes street by street, things can differ so greatly where only, someone with local insider knowledge can really understand the nuances of some of these markets.
Yeah, and what you're seeing statistically is that there is a building of brand loyalty. So that someone who really provides that great level of service in the community, and there people go say, "Oh yeah, those folks are great. I want to rent from them." Or they got another apartment, I want to rent from them. Mm-hmm. It's very catalytic. So I think it's a real benefit. I just don't want us to lose sight that we need capital, but let's not lose sight that we are creating homes and places where people live, and we've got to have a proper balance along the way.
And one thing, Chris, my partners and I were talking about the other day, it seems like even when we started CalCap 16 years ago, you would see sort of a differentiation in cap rates from, region to region, state to state, where now, and I think it's because of the homogenization of capital, maybe, where that's really tightened up, right? Like in the old days, a building in Los Angeles might trade for 100, 150, maybe 200 basis points less than like rural Texas, as an example. But it seems like those spreads have really tightened up as a result of everyone sort of borrows from the same places and gets the same cost of capital, right? Do you think that's the factor there?
I do, but I also will tell you that within the next 10 years, we're going to end up with many of the accounting firms or law firms in this world and in this country becoming certified underwriters, which will commoditize the transaction volume. In other words, so no matter where your money is, if it was underwritten by KPMG or underwritten by, PwC or someone like that, you'd say, yeah, it's fine. I don't have to see the asset. I can just buy the asset. And so I think that commoditization is going to occur much more because capital is so global and it moves around so quickly. And so I think as those things begin to happen, that's why I just keep saying it's what you are building. It's the environment you're building is so critical to differentiating yourself from others, because residents know they have choices and they will make those choices based upon the offerings that are out there. So a little more personalization will be a heck of a lot better result.
Right, because I think, and you and I have talked about this in the past, it seems like what you're speaking of, and especially if the KPMGs become involved as the underwriter and people just sort of rely on them, almost like a triple net leased investment, right? Where it's like, I don't even have to see
Yeah.
it. I'm looking at the numbers. That's great from an investor centric standpoint, but everything's moving more investor centric and less resident centric, right?
Correct.
Would you agree
Correct.
with that?
Yeah,
Where the
absolutely.
experience of so do you think, I guess from a competitive standpoint, having said that, the guy with the boots on the ground, the localized knowledge market, who's more customer centric to the residents, can sort of win out in some of these situations?
Absolutely. I have several examples of clients we've worked with, other companies who have created value, and then they have a waiting list. When are you going to do your next apartment complex? They have 5,000 names of people that I want to get there because I know the values, I know the way you build the buildings, I know how you service the residents, I know how you take care of business, and I know how you contribute back to the community. Those are things that we believe in. And so I think it can just create a whole bunch of opportunity, but you have to have those boots on the ground. You cannot just fly in at 30,000 feet and assume you know everything about everybody and then make a decision and everything could work just fine.
It's funny. I was looking at some of the quarterly earnings for the big REITs, the big multifamily REITs, and they kind of complain because they get valued at a higher cap rate than the market would be, right? If
Yep.
if the assets were individually priced, let's say today's market is, call it 5.5 cap, maybe nationally, and some of these REITs are being priced as if it's a 6.5 cap market. And where do you think that discount is? I mean, do you think that's part of what we're speaking about, where it's this institutional blanketed, focus on investor returns, but yet there's still some differentiation, on a cap rate level where they're being valued sort of slightly, worse off than if it was individual?
The answer is yes, but I'll give you another answer to it as well. There is a huge CYA issue within the capital markets. Nobody wants to quote say you overpaid for that. You paid that kind of a cap rate for that. Everyone is covering their rear ends, and so they don't want to get up in front of an investment committee and say, "Well, gee, why did you do that when everybody else was doing this?" Everyone's got this sort of CYA mentality, and they don't want to overstep their bounds. So it's much better to be overly conservative or state the worst case because you can never get in trouble. And so we have that going on here today. But I mean, come on, at the end of the day, an apartment building that's got resident demand in a community where people need to live and work, it's going to work. We're not having, it's just not going to, it's just not going to be 300 million people living in a tent, so it's just, we're going to do just fine.
Right. Interesting. So let's shift and talk about that a little bit. So what kind of, I know you work a lot with developers, some of the larger developers in the country, actually. What are you seeing in terms of planning new properties, along the lines of features and sort of amenities? I mean, it seems like what we've seen, at least over the last decade, I've been seeing is, new apartment buildings are becoming more like hotels almost from an amenity standpoint, right? Are you
Yes.
seeing that continue to evolve? I mean, where do you think we're going from, if in fact this renter nation, which I agree with you, is happening and more people with more money are now renters, they're also sort of demanding different amenities, maybe health and wellness related. You and I've talked about that. Where are you seeing some of the amenities and what are developers focusing on there?
The one thing the developers have to focus on is creating that differentiating story between your product, and everybody else in the marketplace. And so that is both it's a programmatic and a physical separation. The physical parts, whether that's bike storage or movie rooms or fitness centers or co-working spaces or whatever those things might be, dog washing areas, dog parks, all that. All of that is very much physically oriented. So you have to have those different amenities that are competitive in the marketplace. But the real differentiator is the programmatic elements. Programmatic meaning that, you have cooking class, or you have events, barbecues, or you have other events that happen at the community, which creates, again, that sense of community. As you know, the company called Built, B-I-L-T, who has started, they just raised over $1 billion some dollars. They're doing setting up a reward system. So every time you stay in a unit, you get credit for, like earn points, reward points, like an airline or whatever. And so those points become how well you use the services and amenities, whether that's from box reception, box storage, from bike storage. And again, as I said earlier, all that's happening, but those are programmatic. But then there's a third thing that's happening right now that I'm seeing developers do. We've got some that are doing it more aggressively than others. And maybe you want to talk about this later, but is the whole thing of AI. Because that is, if I have the programmatic elements, I have the physical elements, but how am I changing my operational platform, from leasing to management to maintenance, and how am I using AI to accomplish that? So those are the three sort of legs of the stool coming together, and you can't just do one versus the other. And for sure, you cannot commoditize your services or products for residents, because they know they have choices, and they're going to go to the places that they feel best accommodates their needs. Which also goes back to your point, Ed, is that without boots on the ground, you wouldn't know what those needs are, right? You wouldn't know what those.
That's right.
It's not the same in Dallas as it is in Boston, or not the same in Boston as it is in Fort Worth. in Fort Lauderdale. So they're very different, and that's why that boots on the ground philosophy works really, really well.
But isn't there also? It creates. Having some of these amenities also create additional revenue streams, right? For the property owners, and a way not only to better engage the resident, which is kind of the whole goal here, right? To really understand what they want and need better than your competition. But also there's ways to sort of monetize that.
Yeah. You've seen that insurance and other things that are there. But, one of the things that we preach a lot and work with our clients on is how do we monetize the resident. And that comes from all those things. It could be cable, it could be insurance, it could be services, it could be different amenities, it could be rewards programs, it could be you want a garage, you want a carport, you want a surface parking, you want this, you want that. And there's a lot of optionality around, but everything you do in your computer has optionality. No matter what store you go to, there's optionality. And so if we offer more optionality, that's how we can monetize those kinds of activities in a grander way. And don't forget that if we can build a great resident loyalty, that also can be monetized by having another referral network that comes in. Oh yeah, you got to stay here. You got to come live in this place. These guys are great. That kind of a feeling is going to be needed. So I think it's those three legs of the stool coming together, I think makes a real good output.
And then it sounds like as part of just the overall company branding strategy, right? Where it's like you create the name, you create the experience, and then the tenants will then naturally want to move to another property that you own or manage, or refer people, friends and family, right? To get the same experience.
Yeah, the key word is a valued experience, a valued relationship. Is I value what you're providing to me. It's not just a litany of 25 things I do, but how do I value those? So that's why being in touch with your residents allows you to do that in a better way.
Okay, so let's shift gears now and go back to sort of some of the AI stuff that we talked about and you mentioned earlier, because to me, that's, a lot of things we're talking about is, I guess, high touch experience, right? And where, now AI is going to just the opposite of a low touch experience, which some people also want. So let's talk about kind of, you talked in your white papers a lot about PropTech. It's evolving very quickly, right? From smart home features, virtual tours we're hearing about now, and a lot of just the AI driven models. So what are you seeing in that regard, and how does that relate to your earlier comment about AI?
Well, the PropTech industry is about a $41 billion industry today, and by 2030 or so, may end up being about $90 billion or $100 billion. It's a very big industry. But what happens here in PropTech, and that's a little bit, you have both leasing, maintenance, property management, those kind of things. And then you also have the resident interaction. If you take a look at from an operational perspective, I've been in a lot of meetings with AI folks and other apartment owners and developers. And they're looking at 20 to 30% savings operationally. But what it does is it doesn't take away from the service side of it in connectivity with the resident. It makes the resident's life easier. If I need to communicate something, they're so used to working with their phone and so used to working online that having to walk down to the office and fill out a form, it can be done so instantly in that regard. So it's how you connect with those residents. If it's rainy, if it's snowing, if it's hot, they're not there, they want this, they want that, So that helps. And the same with maintenance. When is the last time we changed the filters? When's the last time the chillers were inspected? When's the last time this happened? Have we looked at all the stoves and the ovens and that? Whatever those components are, it provides you with an automated checklist, which doesn't mean that you have to have someone manually trying to remember all these things. So there's an operational component, which I think would be very valuable. And then there's the programmatic side of it, which I think is rewarding that. But you're going to see, as I said earlier, you're going to see sales assisted by AI and technology and PropTech. We don't even have to go see it. You're going to have all those predictive analytics, which really is a big part of AI, is being able to predict how people behave in the future and going forward here. But also what it does is allows each resident to customize or personalize the solutions that best work for them. And that's going to be very, very helpful. But it's still in its infancy. I've seen a lot of initiatives, but the first tranche of paybacks, it looks like about 20 or 30% savings from an operational perspective, but it's still early. I think that, we went through this wave a long time ago as well, trying to put rooftop, solar panels and everything else. And again, these things are just sometimes an initial euphoria, but when the adults finally arrive in the room, we'll figure this all out. But we're several years away from that. But it's going to be here. And it's be here. Think about, again, those residents you have. They use, like all of us, they use your cell phones, their laptops, their iPads. They communicate electronically. They want certain things to work very well electronically. And so do you as an owner-operator. So that's why I think it's a good blending. We're not substituting personal interaction for computer interaction. We've got to have a good balance there.
Right. So you see it not really substituting, but sort of enhancing their experience, because now it's like, oh, guess what? They can text me on my phone, or I can go on this app on my phone and put in a work order request instead of schlepping down to the office or talking to the maintenance guy or what have you, since everyone lives and dies on their phones anyways today.
Yeah.
That makes more sense.
What if someone falls down in their apartment and they need to call the front, I need help, what are they going to do? Go fill out a form online? It's just not going to work. So I do think there's a good balance here, and we just have to.
But do you think from the operational efficiency side of it, the 20 to 30% savings that people are saying they'll realize? And I think AI is going to be a big component for sure. I don't think it's a fad. I think it's here to stay, and I think it's moving quicker than a lot of us believe. But do you think that's going to, from a staffing, I guess, standpoint, does it impact? I mean, if you have 6 on-site people today, do you think with technology and AI, does that get reduced to 4 on-site people because now leasing can be virtual or something like that?
Well, yes, it'll reduce, just like maintenance. Maybe I have a roving maintenance person versus an on-site maintenance person, and the same thing could happen for leasing. There's a industry word called design day staffing, and they use it in hotels, casinos, and many other places. And apartments have to go that way as well.
Can you explain that? It's called design day
staffing.
Okay.
So, which means that when is the peak time that people are requesting or in need of service and connectivity? Probably between 7 in the morning and 9 in the morning, and probably between 4 or 5 in the afternoon and 7 o'clock at night. That's when everybody's coming to work, going to work, in and out. That's when they see everything. That's when they want to talk. When they're at work all day, they're not going to focus on that. But many times, apartment communities say, "Okay, we're open from 9 to 5." Wait a minute, I'm not even here, So we don't have that. Where, hotels, casinos have done it very differently. So I would be suggesting far more how we shift things around, or maybe during the day. That's going to be a lot more, AI and connectivity, because your people are working and not in their units necessarily. Those who are outside the units, who want connectivity and want to have it in the afternoon or evening when they get back, or in the early mornings before they leave. So I think extended hours, maybe the hours on 2 or 3 days a week should be, office hours could be till 9 o'clock at night if I need that connectivity. So it's understanding who your residents are and how they're responding to that. But there is a balance. I think that's where the savings might be. The other thing, though, is that while we save that, then we end up having to hire 2 or 3 people in AI to work the model. So we,
Right.
we lose it over here, we gain over there. But I think that's why I never want to. While the savings is a nice thing to talk about, I really want to go back again and focus. We're doing this to provide a greater value to the resident. And if we can do that in a good way, that makes a lot of sense, because they'll stay longer and they'll pay more. And that's what's most important.
Yeah, it's funny that you mentioned that design day staffing. I've not heard that term, but I think it also, from an employer standpoint, can make a lot of sense because a lot of people want flexible working hours today. And I think kind of like traditional office space, traditional 9 to 5 has gotten very blurry because of things like Zoom calls and being able to get a text on your phone at midnight and et cetera, et cetera. So that's very interesting to me. And you might have people where, like, a stay-at-home mom wants to get a job, and like all of a sudden, lo and behold, hey, she can work hours now, that she couldn't work before with this flexibility, which could be sort of a win-win, right, for both sides.
Yeah, I mean, if you look even at theme parks, they use design day, and then what they do is people come in through the main gate, and then they go left or right, and they follow the pattern. So why have 10 people selling ice creams at the front gate in the morning? It should move around where the people are. So the ice creams are being sold at the front gate in the afternoon when they're leaving, right? It's how you move people around to allow you the maximum service to the resident or the customer.
And even, traditional factories, I was reading recently, I can't remember where it was, somewhere back in the Midwest, a traditional factory was advertising for employers, and, it's getting harder and harder to find those types of employees for various reasons. But then they went to this flexible model where they had these off-time work hours, not traditional, 8 to 5 or 9 to 5. And lo and behold, like, their applications tripled when they started advertising for a more flexible workforce, which I thought was really interesting.
Yeah, that's a whole nother topic for another session. But
yep.
how do you get accountability and performance or productivity from work from home and that? But that's why we're in this sort of period of transition. That's why I said we're not going back to normal. It's a new normal. It's a new thing, and we're learning all the way along the way here.
But back to the AI from a predictive analytics standpoint, which I agree with you, it's going to go there. I mean, doesn't that kind of further commoditize the investment from that standpoint?
If you use only data for data's sake, yes. If you use data to say, gee, what does that tell me about the services and the things that I need to do to build a relationship with my residents so that they stay longer and pay more? When you're as you know, the higher level of satisfaction one has, the longer the loyalty will be, right?
Yes.
And so we want to build that up so that if we increase rents $50, yeah, but come on, they give us 1,000 more. They're always available. They get this. I got that. I got this. You see, all these things come into bear because it's personalized at that point. And so I just think it's going to be a balance. But it will, predictive analytics, if we use it properly, will help us find the right locations. It'll help us find the right properties, the right products. It will help us in, well, who are the renters going to be? Are they going to be a 55 plus? Are they going to be, university students? Or how is it going to work? And what are those behaviors likely to be? And how do we make a product that really services them based upon their changes in life? That's when you started to begin this interview, this conversation about the Fourth Turning and Strauss and Howe's books on that. And it's really about how people go through generational change. As you get older, you do different things. And that's the same thing in life. Therefore, in your community, in your apartment, you're going to do different things. You may, when you're 20 years old, go out to dinner every night. When you're 40 years old, you may cook 3 or 4 nights a week at home. Just life changes. And so that's why the products and services have to change as well.
Yeah, I agree with you. Can we talk a little bit about current economic times? And interest rates have spiked up, pretty dramatically, right? I mean, when I first got in this business, I was in the mortgage side of the business, 1994, when I moved up here to Pasadena. And basically, rates went down from that time until 2 years ago, right? Almost my entire career. And now for the first time, we're facing headwinds in the industry. So we have, rates that have popped up a couple hundred basis points. The new supply that you spoke about earlier, right? I think there's been 1 million new units delivered over the last couple of years. So those two confluences at the same time have put a strain on multifamily. And then
Yes.
COVID really threw kind of a weird twist into it because we saw an artificial sort of spike in prices, right? When COVID hit, I remember looking at it going, oh my gosh, it's going to be 2008 scenario again, I think. And then lo and behold, prices went the other way and they've doubled, right? Over like a 2-year period. And a lot of people got caught up in that frenzy. Fortunately, we did not. Overpaid for properties at the peak, 21, 22, over leveraged. Now they're going to be in trouble, although we haven't seen a ton of distress now. Seems like we're starting to see a little bit. I just read about some discounted loan sales happening from one of the big bridge lenders. We think Arbor is going to have their difficulties. They were very, very aggressive during that time frame. So let's talk a little bit about maybe some incoming potential distress. What we saw with rates spiking up. I think a lot of people were caught flat-footed. And now, do we see them? Because everyone was banking on, well, rates will come back down. The Fed will lower 5 times in 2024, right? And we haven't seen any of that. And I've always been in the camp that it's going to stay longer or higher for longer, which has kind of proven to be the case so far. And I still think that's going to be the case because I think, the government only has one choice, which is to keep inflation high to inflate us out of the debt problem. So kind of what are your thoughts around interest rates spiking up, where we are in inflationary times and what you think the future looks like in that regard? Can you predict that based on the past?
Well, a couple things. I think the Fed is trying to avoid becoming political this year by having 2 or 3 rate reductions right leading into the election. So we may get one in September, but I don't know if we're going to have any until after that. I do think the outlook is still, I think we'll go down. I think we'll have another 4, 5, or 6 interest rate reductions over the next 18 months or so.
Is that your belief? Once we get through the election, you think there'll be a series of reductions?
I absolutely. But it won't be as quick as, like you said, it's not going to be, it's going to be a gradual. It's not going to be,
right.
A spike on that. The real concern is not for those who borrowed at 60% LTVs. It's for those who borrowed on variable rate notes. Those are the ones that are struggling today because all those conditions you said. And so that's both a challenge for a lot of those people, but it also creates opportunities for those who want to step in and have good capital, a good balance sheet, or they have access to debt at appropriate pricing. But that variable rate stuff is what's going to kill. And we've got over 1.5 trillion, whatever the number is, loans maturing over the next 2 or 3 years, 4 years. And there's just a lot of angst. Most of that's going to be in multifamily and office. Again, if you over-levered and you borrowed because it was cheap and you went up to 70, 80% LTVs, you're going to have some pain. But if you are consistent and you want to be around for a long time, like you guys have been forever, you're prudent. You don't overextend. You do the right thing, and you stay the course, and it pays off every single time.
Yeah, I mean, I think getting back to things never quite the same, but always rhyme. I think one of the rhymes is over leveraging has always been a rhyme in any down market. Anyone who over leveraged pays the price.
Yeah. I think the one thing that it's funny because all the meetings I go to, people talk about that issue of interest rates and stuff. What I think their biggest concern is, I hear more than anything else, is this regulatory insight. That's why people are looking at California and saying, do I really want to be in California? Do I really want to be here? Where should I be? Because of the increasing government intrusion from entitlements and permitting and everything else you've mentioned earlier. So I hear a balance between, you have a cost of capital, but then I got this sort of regulatory environment too. So maybe I can deal with the cost of capital, but if I'm combined with a regulatory environment that costs me more money to build, run, and service these properties, And oh, by the way, I got the regulatory. That is not always a prescription for success.
Right, right. Okay, Chris, I think we're kind of bumping up on time here. So maybe kind of a last question. As you mentioned, we're in a political year right now, and these are crazier times than ever, than at least ever I can remember. How do you see things playing out of curiosity? If you had a crystal ball, right, whether it's a Trump presidency or a Kamala Harris presidency, we know long-term demographically multifamily because of supply demand and more people, becoming renters. We think, the outlook is super, super strong, right, for the foreseeable future, I think, in any rental housing. But how do you think things play out depending on what happens with the election this year?
I think if Trump wins, it's much more favorable to real estate. If Harris wins, it's going to be a lot less favorable to real estate. And you've already seen it. I would not be surprised to see national rent control, if you want to use Freddie, Fannie, federal monies, anything FDI insured, then you're going to have to adhere to inclusionary zoning, rent control, eviction moratoriums. I mean, that I think is more like, you've seen the proposals that Biden put on there recently, and Harris supported. So I think it's much more negative if Harris and company get elected, but it's a lot more favorable if Trump gets elected, at least in terms of where we're going. But at the end of the day, if you peel back all this, noise in the marketplace here, I just wish sometimes we always get what's best for the Americans, what's best for our communities.
Yes.
Yeah. And we need to focus on that because there's no lack of people, like your firm, CalCap, or anybody else. We can solve these problems. We just need for government to get out of the way, and we can get this stuff done really, really well.
That's exactly right. Yes, I totally agree with you on that. I'm always saying that, just leave us alone. We can do better. Free markets do better when they can operate freely, right? Anytime
Exactly.
Government gets involved, it seems to get screwed up and much worse.
It's practical solutions, not political solutions. And
there
I think
you go.
It always works.
Yeah. Well, thanks, Chris. Any parting thoughts before we leave that you want to close out with? I think we've had a great discussion today. I think, real estate is a fascinating topic. You and I could talk about this stuff forever and ever. I agree with you. Housing is a great place to be from an investment standpoint. The country is shifting and changing. We think housing will probably be more of a luxury item going forward, and more people will choose to rent. Some people will have to rent. And I think rental housing will accommodate and get better and better in that regard. And, as we see, like you mentioned, as we see technology and commoditization and PropTech and AI, it really still, at the end of the day, comes down to what is the experience that the resident is receiving, right? And those who provide the best experience are going to win.
Yeah, my last comment to all those listening on this podcast is that we are defining what that new normal is. And you cannot go back to the past. You cannot say, well, I've done this for 20 years this way. I'm going to stay the course. That's you're heading toward a wall. So it's really about thinking longer term about where things are going and creating those strategies and approaches that make good sense for all the listeners on this podcast. So again, Ed, I thank you for the opportunity. And this hour goes by so quickly. So thank you. Thank you again.
Thank you, Chris. Yeah, I think it was great. Appreciate it.
Right. Take care.
I hope today's show inspired you just a little bit, and I would like to thank my guests once again. I'm excited to bring you more episodes with interesting and informative experts to help you navigate your way to wealth and health.
Thanks for listening to the Real Estate Wealth Podcast. The Real Estate Wealth Podcast is produced by Truthwork Media. Our producer is Seth Creekmore, with support from McKenna Smith. For show notes and more information about this podcast, visit edaloe.com. For more information about CalCap Advisors, visit us at calcap.com or follow us on Twitter at CalCap Advisors.
I'm your host, Ed Aloe, and thank you for listening.